Hi, this is Gerry Celaya, Chief Strategist at Tricio Investment Advisors. And today I'm speaking with James Chu, our Head of Investment Solutions. And
Hi, Jerry.
hey, James. And we're going to be talking about structured products and, more importantly, barriers. What do they mean? How can they help you? How can they hurt you? And in general, things we need to keep in mind when we actually talk about structured products with barriers. Is that okay, James?
Okay. Yeah, of course, it's okay. So that is fine. I actually got a slide. I did two slides.
I was going to say, what is a down and, just for people who don't know, what is a down and input? What does that mean?
Okay. Down and input basically is from an option world, and basically a put option usually give you, if you're a buyer of the option, give you protection. So if the market falls or the underlying asset fall, then you got paid. It's like a hedging or insurance policy.
So it's one of those things where in the vernacular it says it gives you the right but not the obligation, correct?
Correct, to sell something at a pre-agreed price. And this pre-agreed price, usually called a strike, is higher than the current price. Otherwise, why exercise the put?
Okay, so let's say right now we're looking at the S&P 500, which is ahead of the Fed meeting 3870 or so. And if I buy a 3600, let's say 3-month down and in put,
Yep.
what does that mean?
Well, basically, let's rewind a little bit first. Let's say 3,600. You said that.
Yep.
So I could buy a put option that is have a strike or exercise price of 3,600.
That's right.
And let's say it's a 1 month option. So at the end of 1 month, if the market is below 3,600, you exercise the put, you sell, and at a level is 3,600, even though the market is 3,400 for argument's sake.
So it
pick up 200
potentially
points.
make some money. Yes.
Yes. Or if you already have S&P, you also have the put. The 200 points basically offset your losses.
That's good. Okay.
Yeah.
Yep.
Now, it's an insurance policy. As you and I know, insurance policy always costs money.
That's correct. That would be the option.
Correct. So in the current market, everyone is scrambling to try to buy put. Higher demand means higher price. So your premium is quite expensive.
That makes sense. Yep.
Yep. Now, how do I make it cheaper? That's when the down and in comes in. Basically, it means that if you buy the put option now, and let's say I have this KI barrier, means not in barrier, basically usually set below the strike. So let's say it's 3,500 for argument's sake. So what it means is that actually that your put option is not alive. Look at the third column. If it's not knock in, when it's knock in, is the underlying price is below the barrier. So between now and the end of, say, 1 month, if the index never drops below 3,500, your put option is not alive. So that means that actually, you think about it, is that actually I want to protect it, my portfolio, or I bet that the market will fall, but I actually think that it will be likely to fall below 3,500. By taking a view, you make the option price cheaper.
Okay, that makes a lot of sense, James.
Yeah. So if that's the case, let's say I buy it, and then actually the index never dropped below 3,500, then fine. I lose some money, but it's not a lot of money. But the option is cheaper as well. So net is okay for me. But if my view is correct, it drops below 3,500, then you actually get your put option. You could exercise a put option. And you basically, in that case, like the case I just said, 3,400, then you pick up 200 points.
Okay, so that's one way to do it. And
Correct.
that is basically the down and in put, right?
Correct. Now, let me just go back and say that two things as well. Two things as well to say. First thing is that you could actually monitor that index or that barrier. You could monitor it every minute, or you could monitor it once a day, once a week, or only at maturity. The more you monitor it, obviously, the more likely that actually the barrier will be touched, and therefore it will be slightly more expensive for the option. You got me on that one?
Yeah, that makes sense as well. So
Yeah,
basically, that would be in the terms of the strategy. It would say how often that barrier is monitored. Yeah.
correct. Now, you and I work in the currency world quite a little bit, and we know that actually currency options, they have these similar barriers knock in as well, and they tend to monitor it tick by tick because the market on currency market is literally 24 hours. But for indices or stocks, tend to be more likely to be daily close, sometimes only at maturity as well. When it is at maturity, that barrier, for some reason, is called European barrier. I think
Okay.
Papa
I guess
Dirigus
that would be
guy,
like the version between American
yeah,
options and European options.
exactly. For if you monitor more frequently, let's say it is daily, then it's American. Maybe the derivatives guy think that Americans are working harder than Europeans.
It could be that, or it might be something
Yeah.
else.
Now, the second point I want to say is that why I talk a lot about the options is because you could take this feature and put it into structured products. And the way to do it is basically is that it's similar in a way that something is not going to be triggered unless it's down. The market is down. And usually that's what we call soft protection. You get hard protection, you always get 100% of capital back and the structured product matures. But you could have this down and need feature of soft protection such that actually if the index falls below the barrier, triggering it, and is end below the strike level or the starting level of the index, you lose money, you lose protection. Now, you build a condition to your protection. Again, your insurance is now a little bit more conditional. Therefore, you get better terms for the product.
Okay. Now, is there any place on the structured product world where somebody would be selling a down and input? And by somebody, I mean a retail client. My suspicion is not. Is that correct?
You're correct. Now, a lot of people will basically say because there are options embedded or similar features embedded or programmed into the structured product, therefore you're selling these put options. The reality is no. The feature is there, but you never do this. You basically use that economic price of that down-in option and put it into the pricing model and make sure that you get the terms pick up in terms of the payout.
Okay, so that makes a lot more sense. Thank you,
Yeah.
James. Now, besides down and in, there's the other type, right?
Yeah, let me just move to the next slide. It's called up and out.
Okay.
Yeah, I usually say it is like a boxer, two boxers fighting each other. You got hit, you got knocked out. And then obviously, and obviously it's a similar thing. Now, this is now, if you think about what we talk about put option is to do with downside protection or capital protection when you actually put into structured products as well. And up and out call is to do with the upside. In other words, return. Now, let's say you use the S&P again. I'm bullish now. I think actually the world is going to be good again. Doesn't matter about the Fed, inflation, etc. It's going to rise in the next 6 months. I buy a 6-month call option at 3,600. Now, obviously, if at end of 6 months the market is above that strike level, you make money. You exercise the option. You get the right to actually sell. Actually, sorry, you get the right to buy the index at 3,600. Now, again, to make it cheaper, what you want to do is actually say that build a condition again, build a wheel, and basically say that actually I think it's going to be higher than 3,600, but it won't be higher than 3,800. If it touches 3,800, depending on the monitoring frequency of the barrier, if it touches it, the option get knocked out. You don't have any the call option is not alive anymore. You don't enjoy any upside gain.
You don't even get that bit between 36 and 38?
No.
That's wiped out?
Yeah. Now
That's
you
harsh.
sometimes actually a lot of these actually have a rebate. So you basically say we got knockout. So just like in the boxing world, yeah, you got knocked out, you probably get a small medal in that of this big medal or big cup or whatever. It's a small medal, and that medal maybe say you get 2% or 3% back.
Okay, so this is how, using an up and out call or various up and out calls, you can construct something for aimed at, let's say, retail savers, where you say, look, if you get participation in the FTSE 100, let's say,
Mm-hmm.
and if it goes up, let's say 6% over the next 5 years, you
Mm-hmm.
get paid whatever. But if
Mm-hmm.
it goes up faster than this, then you get
Mm-hmm.
a smaller percentage, and this structure is no longer in place. Is that correct?
Yeah, I think the easiest way to think about it is, let's say, using your FTSE 100 example, and basically say that actually, let's say if I price up a capital protected structure linked to FTSE 100, and is the participation rate is 60%. So every 1% growth of the index, you got 60 basis point at maturity of the product. So on 60%. Now I say I want it higher. So how do you do it? One way to do it is to what we call capping the return. And using an up and out call, you cap the return by saying that I don't think it will ever be higher than 8,000. I'm just making the number up. So you put that in, and if your view is correct, actually, then you will get payout. The option is cheaper, and what you get is a higher participation rate. You may get 100% participation on the growth, but you know that if the index hit 8,000, you will only get a fixed return.
Okay, that makes sense intuitively.
Yeah,
But how do you put a floor in place? So let's say you get that same FTSE 100 investor, but he doesn't want to lose a lot of money if it starts falling, let's say 5% over the next 3 years. He doesn't really want to bear that pain. How would the structured product work for him? Is that like a down and in or something?
yeah, you could combine both. So you could actually, usually what I've seen is that the up and out call, or the one way of capping the return, usually is used in what I call high protection product. So you, no matter what happened, you got, let's say, 100% capital back, or 98 or 95% capital back. So no matter what happened, you got that, and then you got the upside that is linked to a percentage, let's say 100%, 60%, 80% of the rise of the index. That's usually what happened. When you cap it, that means that when it hit the barrier, you got knockout, and then you got the a fixed return instead. So that's what it is. But you can also combine it, and actually you say, okay, I don't mind actually having a soft protection feature. So I have a down and input with a very deep barrier, like 60% of starting level or 70% of starting level, that allows the index to fall up to 30% or 40%. And using that, you could even get more better terms. You combine it with an up and out call.
Okay, so by the combination of these, you get some of the upside, or potentially quite a lot of the upside, and you get some protection from a calamitous fall. Is that
Correct.
probably okay?
You think about it, what I'm doing, despite all the terminologies here, what I'm trying to build is to build in conditions. The simplest product is hard protection, 100% capital back, and you get a growth. You want more growth, you either take some risk to your capital using soft protection feature. If you want even better upside, you basically say, I want to be in a wheel, and that the index or the stock or whatever the underlying is will not go above that barrier. So that is how you build things with structured products. Remember, the more specific your wheel is, the more likely that you get better terms. But remember, at the same time, these better terms may have a low probability of happening because your conditions are so tight.
Those are really good points to make, James. Thank you. Okay.
So again, just like the soft protection feature, this up and out or the capping also have different monitoring frequency. You can monitoring intraday, every day, or only a maturity?
Fantastic, James. Anything else that we should be touching on in terms of the barriers in this brief?
No, I think that's it. I think it's still public. It sounds very jargony, but as I said, the whole thing is translated into market views. You're actually advising a client to buy structured products. Look at what actually the conditions are there to give the clients a return, and then basically say, okay, is the client will and also your market will align with the product? If that's the case, then maybe it's good product for them. And you need to keep monitoring this. The barriers may get bridged on the soft protection side or on the cap side. You need to keep monitoring this and make sure that if there's a likelihood that these barriers are touched, you may want to sell the product early.
That makes a lot of sense. Thank you, James.
Thank you very much.
All right, we'll have another conversation about other ideas in the structured product world at some stage over the coming months. Thank you.
Sure, of course. Thank you.
All right, take care.
Thank you.